Well, it is rare to find a power utility having debt to equity of mere 0.7 times and debt to EBITDA of 2.76 times. JSW Energy has remained strong despite the crisis on the back of its focus on conserving cash and keeping control over leverage. In our ideas for profit today, I will discuss if this utility major should be on investors' radar. Let's look at the Q4 earnings first. Well, JSW Energy has close to 4,500 megawatts of operational capacity, and over the years, the company has really reduced its exposure to merchant power, and today the power sold through the long-term agreements or PPA accounts for almost 70% of its total capacity and 90% of its EBITDA. Now, because of the long-term contracts, the company was able to control damage caused by the impact of COVID-19. Now, during the March quarter, the company saw close to 7% decline in revenues, led by 3% decline year-on-year decline in the generation volumes. However, the impact on profitability was relatively low due to the reduced operating costs. Now, its total expenditures were also down by close to 16%, and this really helped in higher profitability. The company's EBITDA was up by 21% on a YOY basis, and EBITDA margins also improved by 786 basis points to 32%. Now, margins were also boosted because of the better revenue mix. During the quarter, offtake of long-term power also dipped because of the low economic and industrial activity, and the company was also increased its short-term power offtake. Now, the company is sitting on a cash and cash equivalent of over 2,000 crore rupees, which is about 30% of its current market capitalization. Now, company's overall realization per unit also improved to 4.4 rupees per unit in Q4 as against 4.3 rupees per unit in Q3. Further, the company was also able to reduce the interest cost, which fell by close to 6% year-on-year in the higher profits, resulting in higher profits. Now, while quarterly results were definitely reasonable as against expectations in the light of COVID-19, the situation is challenging considering the lower electricity demand. Now, this is already reflecting in its performance, as a result of which the plant load factor has dropped across the plants. Now, the impact was actually limited in March quarter, but the pain could continue in at least the first half of the current financial year. Now, this also calls for the lower earnings growth expectations. Now, Street has already cut the earnings expectation by about 30 to 40% for the current year, but it actually expects the recovery in financial year 2022 as demand normalizes. Now, the company has strict plans to conserve cash, and in a bid to shield the balance sheet, it has postponed its plans to acquire GMR's Kamalanga project as well. It is cutting costs and streamlining operations to save the money and constantly monitoring its receivables, which could face challenges in the light of stress in the power sector. Now, the current fiscal's focus would be about conservation and controlling the damage more than earnings, which could be really lower. Now, investors should therefore look at the stock from a 2022 perspective, when the earnings are expected to normalize. Because of this, the interim pain, the stock is also available at just 7 times the fiscal year 2022's estimated earnings. So one should really look at adding the stock on dips for the long term.